$6. That's what a basic Domino's pizza can cost you on a promotion night. $6 for dough, cheese, sauce, a box, a driver's gas, a driver's time, and somehow still a profit. Look at that number for a second and it doesn't make sense. Flour costs money, cheese costs money, labor costs money, delivery costs money. Add it all up and a $6 pizza should be a loss leader, a marketing stunt, maybe even a mistake. And yet, Domino's has been selling pizza at prices like this for years, while quietly becoming one of the most profitable fast food companies on the planet, with a stock that has outperformed Apple, Amazon, and Google over large stretches of the last 2 decades. So how does a $6 pizza turn into a multi-billion-dollar company? The honest answer is that you're asking the wrong question. You're assuming Domino's makes its money selling pizza. It doesn't. Not really. And once you understand what Domino's actually sells, the $6 pizza stops looking like a mystery and starts looking like one of the smartest structural tricks in modern retail. Here's the reframe that changes everything. Domino's is not, in any meaningful financial sense, a pizza restaurant chain. It is a supply chain operator and a royalty collection company that happens to have pizza as its product. In its own 2024 annual filings, Domino's reported total revenue of $4.7 billion. Of that $4.7 billion company-owned restaurant sales, meaning the pizza actually cooked and sold in stores Domino's itself operates, brought in just $394 million. That's less than 8% of total revenue. The single largest line item on Domino's income statement, by a massive margin, was something called supply chain revenue, which alone brought in $2.8 billion, more than 60% of everything the company made that year. Read that again. Domino's makes far more money selling dough, cheese, boxes, and ingredients to its own franchisees than it makes selling pizza to customers. The pizza on your table is almost a side effect of the real business happening behind the counter. To understand why, you have to understand who actually owns a Domino's store. It's almost certainly not Domino's the corporation. Out of the roughly 21,000 Domino's locations operating worldwide by the end of 2024, the parent company directly owned only 292 of them, a little over 1% of the entire chain. The rest, over 21,000 stores, are run by independent franchisees, ordinary business owners who paid for the right to operate under the Domino's name. This is the exact same franchise structure that shows up again and again across the fast food and retail world. The same basic architecture you'd find behind a McDonald's or a 7-Eleven. The corporation doesn't want to be in the business of flipping pizzas or scheduling delivery drivers at 3,000 individual locations. That's slow, expensive, and operationally brutal. Instead, the corporation wants to be in the business of collecting money from everyone else who is willing to do that hard, physical, thin-margin work on its behalf. So when a franchisee sells you that $6 pizza, several different hands are quietly reaching into that transaction before the franchisee sees a dime of profit. First comes the royalty. Under Domino's standard U.S. franchise agreement, franchisees are required to pay a royalty fee of 5.5% of their total sales every single week, regardless of whether that particular week was profitable or not. This isn't a fee on profit. It's a fee on revenue, meaning Domino's corporate gets paid whether the franchisee's store is thriving or barely surviving. On top of the royalty, franchisees also contribute to a national advertising fund, another required percentage of sales that pays for all those Super Bowl commercials, all those 30-second spots reminding you that pizza is one tap away. In 2024 alone, that advertising fund collected $510 million from U.S. franchisees. Individually, these franchisees are small business owners hoping to make a living. Collectively, through royalties and advertising fees, they are quietly funding a corporate machine that generated $638 million in pure U.S. royalty and fee revenue in a single year. But the royalty is actually the smaller story here. The real engine, the one that explains almost the entire shape of Domino's as a company, is the supply chain. Here's how it works. In the United States, Domino's doesn't simply let franchisees buy dough, cheese, sauce, and boxes from whichever supplier is cheapest that week. Instead, the company operates its own network of regional dough manufacturing and food distribution centers, factories, and warehouses spread across the country, whose entire job is to produce and deliver standardized ingredients to Domino's stores. When a franchisee needs more mozzarella, more pepperoni, more delivery bags, more pizza boxes, they order it directly from Domino's own supply chain division, and Domino's sells it to them at a markup as a business. This single division alone generated $2.8 billion in 2024, more revenue than the royalties, the advertising fund, and the company-owned stores combined. Domino's has, quietly and deliberately, become the middleman in its own franchise system, selling ingredients to the very people who are also paying it a royalty to use its name. This is, honestly, a genuinely brilliant piece of business architecture, and it explains something that used to genuinely puzzle outside observers of the company. For years, analysts described Domino's using an odd phrase. They said it was mischaracterized as a restaurant chain. The company itself, in its own strategic language, describes what franchisees are actually buying from it. It isn't just permission to use a brand name. Franchisees are buying access to an entire operating system, a package that includes the Domino's brand, the supply chain relationship, the proprietary technology stack, ongoing marketing support, and a proven set of operating procedures refined across tens of thousands of stores worldwide. What the customer buys at the counter is a pizza. What the franchisee buys from corporate is a business in a box, engineered for consistency at massive scale. And this brings us back to that $6 pizza, and why it can exist at all without bankrupting anyone. Because Domino's corporate doesn't primarily need that $6 pizza to be wildly profitable at the store level. It mainly needs that pizza transaction to happen at all, as many times as possible, across as many stores as possible. Because every single transaction triggers two separate, nearly guaranteed revenue streams flowing straight back to headquarters. There's the royalty, taken as a fixed percentage regardless of the franchisee's actual margin that week. And there's the ingredient purchase, since the flour, cheese, sauce, and box that went into your $6 pizza were very likely bought by that franchisee directly from Domino's own supply chain division at a price set by Domino's itself. The $6 promotional pizza might genuinely be a thin margin item or even a rough break-even item for the individual franchisee standing behind the counter. For the parent corporation sitting quietly above the entire system, that same pizza is nearly pure, repeatable revenue, twice over, collected automatically no matter how good or bad that store's week actually was. This is precisely why volume matters so enormously to Domino's. In a way, it doesn't matter quite the same way to, say, a fine dining restaurant trying to maximize profit per plate. A high-end restaurant wants each individual meal to carry strong margin because they're only serving a limited number of covers each night. Domino's wants an almost unlimited number of transactions, even thin margin ones. Because thin margin times millions of orders, repeated weekly across 21,000 stores worldwide, adds up to a genuinely enormous, remarkably stable, largely automatic river of royalty and supply chain revenue. The $6 pizza isn't a mistake in this system. It's practically the point of the system. It's bait engineered to keep the ordering habit alive, to keep customers reaching for their phone instead of a competitor's app, because every single order, cheap or expensive, quietly feeds two separate revenue streams that belong almost entirely to corporate, not to the franchisee sweating over the oven. Understanding this reframes the entire history of the company too, and where it actually came from. Domino's didn't start as a supply chain empire. It started in 1960 in Ypsilanti, Michigan, when two brothers, Tom and James Monahan, borrowed $900 to buy a single struggling pizza store called Domino's. James sold his half of the business back to his brother within the year, reportedly trading his ownership stake for a used Volkswagen Beetle, one of the more famous accidental bad trades in American business history. Tom Monaghan kept building, focusing early stores near college campuses and military bases, leaning hard into a promise of fast delivery that would eventually define the entire brand. For decades, Domino's grew primarily as an operator, a company that opened and ran pizza stores. The supply chain and royalty structure that dominates its financials today developed gradually as the company shifted its own stores over to franchisees and built out the infrastructure to service them centrally, transforming itself, quietly, from a restaurant operator into something closer to a logistics and royalty business that happens to sell pizza. That transformation is the real story behind the $6 pizza, and it's only the beginning of understanding how this company actually works. In Part 2, we're going deeper into exactly how that supply chain profit gets split with franchisees, why Domino's nearly collapsed as a brand in the mid-2000s before reinventing itself around technology and digital ordering, and what happens to this entire carefully balanced system when commodity prices spike, delivery apps muscle in, or a promotional pizza war goes too far. When we left off, we'd uncovered the core trick behind Domino's entire business. The pizza itself is almost a side effect, while the real profit engine is a combination of royalties and an enormous internal supply chain that sells ingredients to franchisees. But there's a deeper layer here that most people never see, and it's the part that actually explains why franchisees willingly participate in a system that seems, on the surface, to squeeze them from two directions at once. Because if Domino's corporate is charging a royalty and also selling ingredients at a markup, you'd expect franchisees to eventually get frustrated and look for cheaper suppliers elsewhere. In earlier years of the company's history, some franchisees actually pushed back on exactly this arrangement, and Domino's had to answer a genuinely important question. Why would any rational business owner buy overpriced dough from their own franchisor instead of shopping around? The answer Domino's built is a profit-sharing arrangement, and it's one of the more clever pieces of financial engineering in modern franchising. According to the company's own regulatory filings, Domino's generally shares 50% of the pre-tax profits generated by its regional dough manufacturing and supply chain centers with the domestic franchisees who agree to purchase all of their food and ingredients through that same supply chain system. In plain terms, if the supply chain division makes a healthy profit selling dough and cheese to franchisees that year, half of that profit gets funneled back out to the franchisees who bought from it. This single mechanism transforms what could have been an adversarial relationship, franchisor extracting margin from franchisee, into something closer to a shared incentive. The more efficiently Domino's runs its supply chain, the more profit there is to share, and the more franchisees benefit from staying loyal to the system instead of hunting for outside suppliers. The results of this arrangement are, frankly, remarkable by franchise industry standards. Domino's has reported that participation in its domestic supply chain system runs above 99% voluntarily, meaning virtually every eligible franchisee chooses to buy through corporate rather than sourcing ingredients independently. Franchise contract renewal rates run around 99% as well, and collection rates on royalty and supply chain payments also sit above 99%. These aren't the numbers of a system where franchisees feel trapped or resentful. They're the numbers of a system that has been carefully tuned so that staying inside it is simply the obviously smart financial choice for almost everyone involved. The $6 pizza, in other words, isn't just profitable for corporate. Structured correctly, with the profit sharing flowing back down, it can genuinely work out reasonably well for the franchisee too, as long as the underlying store is running efficiently and hitting real volume. This entire model, though, wasn't always this polished. To understand how fragile this kind of business can actually be, and how close Domino's came to unraveling before it built the sophisticated system we just described, you have to rewind to the mid-2000s. Domino's went public on the New York Stock Exchange in 2004, raising around $300 million, largely to pay down debt the company had accumulated. For years after that, the brand carried a quiet, persistent reputation problem. Surveys and taste tests routinely ranked Domino's Pizza near the bottom among major national chains, behind Pizza Hut, behind Papa John's, sometimes behind grocery store frozen pizza. Sales growth stalled. The stock, which had once looked promising, drifted and struggled. Internally, executives were staring at a brand built on fast delivery and a franchise machine, but sitting on top of a product that a large share of its own customers didn't actually enjoy eating. In late 2009, Domino's did something that very few major food brands have ever done. It publicly admitted in a national ad campaign that its own pizza wasn't good. Executives appeared on camera reading real, unflattering customer feedback, comments calling the crust cardboard and the sauce like ketchup, and promised the company was completely reformulating its recipe from the ground up. This was an enormous gamble. Admitting your core product is bad on national television could easily have been the final blow to a struggling brand. Instead, it became one of the most studied turnaround campaigns in modern marketing history. Same-store sales, which had been flat or declining, jumped sharply in the months following the campaign. The stock, trading in the single digits during the depths of the 2008 financial crisis, began a genuinely historic climb, eventually becoming one of the best-performing stocks in the entire S&P 500 over the following decade, at various points outperforming Apple, Amazon, and Google on a percentage return basis from that low point. What actually saved the company, though, wasn't just a better-tasting pizza. It was the combination of that reputational reset with a second, quieter transformation happening at the exact same time. The shift toward digital ordering and heavy investment in technology, all of it funded largely by that same dominant supply chain and royalty revenue stream we described earlier. Domino's built its own ordering platforms, invested in tracking technology that let customers watch their pizza move from oven to car to doorstep, and pushed aggressively into app-based and online ordering years before most of its competitors took digital seriously. This mattered enormously for the underlying economics, because digital orders tend to carry a larger average ticket size than phone orders. They reduce labor costs tied to taking orders manually, and they generate an enormous stream of customer data that helps optimize everything from promotional pricing to delivery routing. None of this technology investment would have been affordable at that scale for thousands of individual small franchise owners acting alone. It was affordable because the corporate parent, sitting on top of billions of dollars in supply chain and royalty revenue, could fund it centrally and roll it out system-wide. This is really the final piece of the puzzle explaining how a $6 pizza survives as a business. The pizza itself is priced competitively, sometimes barely above cost, specifically to win the order. Once the order happens, three separate revenue streams activate almost automatically: the royalty on that sale, the markup on the ingredients that likely came through Domino's own supply chain, and the long-term value of a satisfied, habitual customer who now has the Domino's app on their phone and will likely order again next week. Multiply that pattern across millions of transactions a year, across more than 21,000 stores worldwide, and you get a business capable of generating close to $600 million in annual net income, not from selling expensive pizza, but from selling an enormous volume of moderately priced pizza through a system engineered to extract value at every single step of that transaction. Of course, none of this makes the model risk-free, and it's worth being honest about where the cracks can show. Franchisees still carry real exposure. If wheat prices spike, if cheese costs surge, if minimum wage increases push labor costs higher in a given state, franchisees absorb much of that pressure directly at the store level, even while corporate continues collecting its royalty regardless of the franchisee's actual margin that week. The rise of third-party delivery apps has also complicated the picture, pulling some customers away from Domino's own app and forcing the company to either match those platforms' convenience or risk losing order volume to competitors who never have to build their own delivery fleet. And the profit-sharing arrangement that keeps franchisees loyal to the supply chain system only works smoothly as long as that supply chain division stays genuinely profitable and efficiently run. If commodity costs rise faster than Domino's can pass them along, or if a poorly managed distribution center starts losing money, the entire trust relationship holding thousands of franchisees inside the system starts to strain. So the next time you see a $6 pizza deal flash across your phone screen, you'll know what's actually happening behind that price tag. You're not looking at a company giving away pizza at a loss out of generosity. You're looking at the visible tip of a much larger machine. A royalty engine collecting 5.5% of every sale, a supply chain division quietly selling the dough and cheese that went into your order, a profit-sharing arrangement designed to keep thousands of independent franchisees loyal to that same supply chain, and a technology platform built almost entirely on the back of that revenue. All of it stacked underneath a brand that very publicly admitted its pizza used to taste like cardboard and rebuilt itself into one of the most quietly profitable food companies on earth. The pizza was never really the business. The pizza was just the excuse everyone needed to keep the actual business running. So the machine works. Royalties flow in regardless of whether, supply chain profits get split back down, franchisees stay loyal, and the whole system compounds quietly year after year. But machines, this precisely tuned, have a specific kind of vulnerability, and it's worth understanding exactly where the pressure points sit, because they explain almost everything happening in Domino's world right now. Start with the most obvious one: geography. Everything described so far describes the domestic U.S. system, where Domino's built its own dough factories and owns the entire supply relationship. Internationally, the picture looks completely different. Domino's doesn't operate that same vertically integrated supply chain in most of its overseas markets. Instead, it relies heavily on a network of master franchisees, large independent operators who buy the rights to run and sub-franchise Domino's across an entire country or region. In India, for instance, the Domino's brand is run almost entirely by a separate, publicly listed company that licenses the name and operating system, not by Domino's corporate directly. This matters because it means the beautiful, self-reinforcing profit-sharing loop that keeps American franchisees so loyal doesn't automatically exist everywhere else. International growth for Domino's looks less like extending a machine and more like planting the same seed in different soil, hoping local partners can rebuild something similar. Some markets have done this brilliantly. Others have struggled, and a few master franchise relationships have ended in messy, expensive divorces. Then there's the delivery app problem, and this one strikes right at the center of what made Domino's special in the first place. For most of its history, Domino's core competitive advantage wasn't really the pizza. It was delivery infrastructure. Decades before Uber Eats or DoorDash existed, Domino's had already built an entire logistics operation: drivers, routing, hot bags, tracking systems, designed around one single promise: get food to a door fast. That infrastructure was expensive to build and almost impossible for a small competitor to replicate, which is exactly why it worked as a moat for so long. Third-party delivery apps changed that equation overnight. Suddenly, any restaurant with zero delivery infrastructure of its own could offer delivery by simply signing up with a platform that already had drivers everywhere. The moat that took Domino's decades to dig became something a competitor could rent for a monthly fee. Domino's response tells you a lot about how seriously the company understands its own economics. Rather than rushing to list itself heavily on third-party apps and hand over a cut of every order to an outside platform, Domino's spent years doubling down on its own app and website, even at the cost of near-term order volume. The logic here connects directly back to everything from Part 1 and 2. Every order placed through a third-party app means Domino's is now sharing a slice of that transaction with a delivery platform, on top of everything else already flowing through the system. An order placed directly through Domino's own app keeps that entire royalty and supply chain value intact. So the company has quietly trained an enormous share of its customer base to open the Domino's app specifically, rather than defaulting to whichever delivery platform happens to be open, and that habit alone is worth an enormous amount over time, because it protects the two revenue streams the entire business is actually built on. Commodity prices are the next pressure point, and they hit differently depending on where you sit inside the machine. When wheat prices spike or cheese costs surge, franchisees feel it first and most directly because their day-to-day margin on each pizza compresses immediately. Domino's corporate, meanwhile, is somewhat insulated in the short term since the royalty is calculated as a percentage of sales revenue, not profit, so it keeps collecting its cut even in a quarter where franchisee margins are getting crushed. But this insulation only goes so far. If commodity costs stay elevated long enough, franchisees start closing underperforming stores, delaying new store openings, or in the worst cases, exiting the system entirely. Fewer stores means fewer transactions, and fewer transactions means the entire royalty and supply chain engine slows down with them. So while corporate isn't directly exposed to a flour price spike the way a franchisee is, it is deeply exposed to what happens to franchisees over a longer horizon, which is exactly why that 50% profit-sharing arrangement from Part 2 matters so much. It's not generosity. It's insurance. Keeping franchisees profitable enough to keep opening stores is the only way the entire structure keeps compounding. There's one more layer worth mentioning, because it's the part almost nobody outside the industry pays attention to: real estate and store density. Domino's growth strategy for decades has deliberately leaned into something that sounds almost self-destructive on the surface, opening new stores close enough to existing ones that they cannibalize a portion of each other's delivery radius. Executives have openly defended this strategy, arguing that a slightly smaller delivery radius per store means faster delivery times, lower delivery cost per order, and ultimately a better experience that drives more total orders across the cluster of stores than one single larger store could generate alone. It's a strategy that only makes sense once you remember what the actual product being optimized is. If the goal were maximizing profit per individual restaurant, cannibalizing your own store's territory would look insane. If the goal is maximizing total transaction volume across the entire royalty and supply chain system, deliberately shrinking delivery zones to shorten delivery times is exactly the kind of quietly aggressive move you'd expect. Put all of this together and Domino's stops looking like a pizza company that got lucky with a clever ad campaign in 2009. It looks like a business that identified, decades ago, that the actual product worth optimizing wasn't the food on the plate, it was the transaction itself, and everything since then: the supply chain build-out, the profit-sharing formula, the technology investment, the store density strategy, the resistance to third-party delivery apps, has been built around protecting and multiplying that transaction as many times as possible, as efficiently as possible, across as many doors as possible. The $6 pizza was never really about the pizza. It was always about the machine underneath it, and understanding that machine is the closest thing to understanding modern franchise capitalism itself.